Oftentimes, when you say the word investment, the listener's mind will automatically link that word with the word shares. They would assume that you are investing in shares of a company. Although there are many other assets that we can invest in, shares will, more often than not, be the first word that pops up in their mind. It is hard to argue against the notion that shares is the most focused on investment asset. For example, when we look at Warren Buffett's investment portfolio, we will focus on the shares that he holds, like his investments in Apple, Coca-Cola, and Kraft Heinz. Do we even care that Warren Buffett's portfolio also includes holdings in Spider's S&P 500 ETF Trust or Vanguard 500 Index Fund ETF? But what exactly are shares of a company? To give an oversimplified definition, essentially, it is a part ownership of a company. So if Company A has issued 100 shares and you own 10 of those shares, that means that you own 10% of Company A. To be relatable, let's look at a real-life example. The McDonald's Corporation. At the time of writing, McDonald's has 746.6 million shares outstanding. Let's say that you own 10 McDonald's shares. That means that you own 0.000013% of the greatest burger company in history. So, what does that mean for you as a shareholder of McDonald's? Can you run the company? Can you dictate its business strategy or operational policies? At 0.000013% shareholding, no. To be able to have an impact on McDonald's business and operations, you will need to have a substantial shareholding, at which point you can request to be made a director on their board of directors, of course, subject to processes and approvals. Then, what benefits do you get as a shareholder of McDonald's or of other companies? Essentially, from a practical retail investor point of view, there are three benefits. One, you can get dividends. Basically, dividends are money that the company can choose to give to you just because you are one of its shareholders. Two, you can get certain shares-related benefits, like a rights issue or bonus issue. And three, you can sell your shares, either for profit, also known as capital gains, or for a loss, also known as, well, you lose money. In order to truly enjoy the main practical benefits of being a shareholder, in other words, to receive dividends and to see the share price go up, we need to make sure that we invest in a good company. This is because a good company should be able to make profit consistently. The more money the company has, the more frequent they can pay you dividends. Also, because the company makes money consistently, more and more investors will want to buy their shares. This will cause the price of the shares to go up. Of course, there are more factors to consider when it comes to determining whether a company is a good company or a bad company, something we may cover in another video. Essentially, just remember that when we buy shares in a company, we are buying part ownership of that company, and it is better to own a good company than to own a bad company.